We wrote this article because the stock market's in the news every day, and there's not a lot of really thorough analysis of what's behind the numbers. And secondly, because our clients often are curious about the numbers, and they see the very high value of the stock market indexes, and they want to know what that means. What are we facing a big downturn or whatever, and what would the impact of that be? So that's one of the reasons why we do this, and why we try to understand how the value as a market as a whole is valued. At the same time, we find that individual clients always believe that their own stocks are undervalued. Not a surprise. And so what we're trying to do is reconcile sort of the stock market index as a whole and the valuations of individual companies and individual industries. And we found that actually when we do the analysis, that the apparent disconnect disappears. Oftentimes we find when the stock markets move in strange ways is that people don't really understand or look at what's the underlying drivers of the market, and they don't decompose it to see what anomalies are underneath the indices. You really need to take apart when you're analyzing the stock market and to sort of really see one or sometimes two levels down what's really going on in terms of what's driving the index. And so right now, when you do this kind of analysis, you discover that the price earnings ratio isn't that much out of line with sort of historical numbers. So we can take that number, that price earnings ratio, let's say 16 to 17 times, and we can effectively reverse engineer and say, what would we have to believe about future economic growth and the cost of capital to justify that value? And essentially what we do, one way to do this and what we do is we develop a discounted cash flow model where we reverse engineer and say, okay, if I make certain projections about profit growth, if I make projections about return on capital and therefore reinvestment rates, and if I make assumptions about the cost of capital, I can see sort of what's built into those valuations to see whether they're reasonable or not. Right now, if you take and do that for the S&P 500, what you would find, if you make an assumption that the S&P 500 will continue to earn about the same marginal return on equity as it has, which is about 22% or so. If you make an assumption that the cost of capital, cost of equity is roughly around 9%, which our research suggests it is and has been for a while, and then you solve for the growth, you would see that corporate profits only have to grow about 4.5% a year in order to justify that current valuation of the stock market. Anytime you're talking about a stock market index, is essentially a sum of a large number of companies, particularly the S&P 500. We're in a place right now where there are 4 companies in the S&P 500 who are very highly valued, who in a way distort the index. And those are Facebook, Amazon, Microsoft, and Google. So if you were to take something like the S&P 500 index and say that the forward price earnings ratio right now is in the high 18 times, you'd say that seems very high. And yet, if you were to subtract out those 4 companies, that comes down by almost a whole point. So in other words, part of the index is being driven by these 4 companies, which have very high valuations, and no one really knows whether those are sustainable or not. Secondly, we also have an unusual situation right now where large U.S. companies, particularly pharmaceutical and tech companies, have very significant amounts of cash parked overseas, which are not earning anything. And we're on the order of magnitude of $1.5 trillion. And the reason that they're holding it overseas is they're waiting for the tax law to change, and now much of it will come home. But as a result of that, that also distorts the price earnings ratio for the market as a whole. Even when you go back in other periods, you find that often the distortions, or when the market seemed to be valued strangely, it was often because of a small number of anomalies. So for example, if you go back to the year 2000, 1999, when we had the dot-com bubble, the S&P 500 was distorted by a small number of very large mega cap companies that had unrealistically high valuations, but there were most of the companies in the index had very reasonable valuations. And in fact, when the stock market went down later in 2000, 2001, fully 40% of the stocks in the S&P 500 went up in value. So once again, the averages or the aggregates sometimes mask the interesting things that are going on underneath. So when you put it all together, when you take apart the price earnings ratio into and then adjust for some anomalies, and then you look at how this relates to economic fundamentals, we find that the valuation of the stock market doesn't really seem to be that unreasonable in light of sort of what potential profit growth might be, given a cost of capital that we've seen typically around 9%.